Kim. Okay, good morning, everybody. Happy Thursday and Happy New Year. First session for the year 2023. Yeah, it is 2023. And super excited about opening the session with C.A.R. Chief Economist Oscar Wei. We have the pleasure of having Oscar two, maybe sometimes three times a year to kind of get the insight and some stats and numbers about what happened and maybe what will happen. So Oscar is going to recap 2022 for us today. Looking forward to hear more of that. And of course, he's going to share some other stats. Most of you, if not all of you, know Oscar Wei, but just in case, and whoever's going to watch the recording, Oscar Wei is the Deputy Chief Economist at the California Association of Realtors, C.A.R., a statewide trade organization of real estate professionals with more than 200,000 members. It's keep rising. He co-manages the research and economic department and oversees the operations of data analytics and survey research within the division. As an economist at C.A.R., Oscar provides regular updates on the economy, state and regional housing markets, consumer behavior, and public policy issues. He has written articles and reports on subjects including housing supply, affordability, mortgage finance, homeownership, tax reform, and other topics related to the real estate industry. Oscar contributes frequently to C.A.R.'s weekly housing market update newsletter, Housing Matters podcast, which is great, and Housing Perspective. His work has been quoted in the Los Angeles Times, San Francisco Chronicles, Kimpler's NPR, KFI, as well as other media outlets. Oscar, pleasure to have you as always.
Great. Thank you, Manny, for the introduction. I forgot to ask earlier, you have audience in person live as well, or no?
So some offices, yeah, people are sitting in the offices and watching us, but the majority are over Zoom, and we have people from outskirts of Orange County, Long Beach, Palos Verdes, South Bay, West Side, and the Valley area. So it's kind of pretty much the center of the SoCal.
Got it. The reason why I ask is, in case, we have time for Q&A, and hopefully we do. And if it's a question from an audience who attend in person, I may not be able to listen very clearly, and I may need someone to help me let me know that questions or repeat that question so that I can answer it clearly afterwards. But we can take care of that afterwards.
Absolutely, yeah. And side note before Oscar is gonna take the screen. If you have any questions, because Oscar just like to go from the beginning, that he's gonna run and cover tons of different things. It's gonna fill our head with good information. Type in your questions on the chat, so then we can go back and address it. And later on, if you need like more clarification, we can unmute yourself at the end, not doing the presentation, and then ask more questions. So just make some notes. Oscar, all yours.
Perfect. Thank you, Manny, for the clarification. Good morning, everyone, and Happy New Year. I'm glad to be here. Glad to be here to share some information with you every year, a couple times every year. This is, of course, this year, and of course, second half of last year, maybe 9 months of last year. It's been pretty challenging and a lot of uncertainty. So it's good to have some good information to kind of guide through what we can do, what we can expect in the upcoming year. Now, as usual, I have my presentation. I have a slide deck, and I share that with Kim. I share that with Manny, and so Manny and Kim, feel free to share with the audience afterwards. And I also will have that presentation posted on the C.A.R. website. But let me put it up, and let's take a quick look at the presentation. You'll see a blue screen first, and let me turn on the presentation. Can you guys see?
Yep, we can see.
Perfect. So let's get started. Now, of course, we have had, maybe about 6 or 7 months of a really tough time, in the last, since maybe March or April of last year. At the beginning of last year, 2022, we didn't expect the interest rates to have gone up, that much. Right now, if I remember, I looked at the number yesterday, and I believe the average I think Freddie Mac might have released some numbers this morning, but I haven't read it. It's probably somewhere around 6.2, 6.3% for the 30-year fixed rate right now, or what they collected earlier part of the week. Because typically what happened is Freddie Mac collects their weekly survey number based on survey that ends maybe on Tuesday or Wednesday or so. Now, of course, this morning we have some new numbers out on inflation, which I'll go over shortly. The last couple of days, or last few days, we actually got some numbers that actually got the interest rates down slightly, actually since last Friday or so. Interest rate dipped slightly, and that's because of concern about there's maybe some easing of inflation concerns that actually drag down interest rates to somewhere around 6.2, 6.1, 6.2. Now, it's hard to imagine that about a year ago we had interest rates 30-year fixed rate at below 4%, and now we're talking about 6% being low compared to maybe 3 months ago we had somewhere around 30-year fixed rate at 7%. But things are going to if we might have already seen the peak, peak of the interest rates, but of course I don't know for sure. I do not believe, though, that the current rate level is going to persist. I think it probably will go up slightly. I may not reach 7% again, but it'll probably go up slightly before it come back down later on this year. And I'll explain a little bit more why I think that is the case. Now, here's what I'm going to cover in the next 15 minutes, an hour or so. We're going to look at the big picture. We're going to first take a look at the economy, because that actually can give you some idea of where the market is going. Because we have a few things that dictates interest rates: inflation, obviously, and of course whether the economy is going into a recession or not. I think most people now believe that, myself included, that we might actually see like a mild recession. And because of that reason, I think economists and people in the market would hope that the Federal Reserve would actually ease their Fed funds rate increase in the next meeting or so, which is going to be in February, very shortly, maybe in about 2 weeks, 3 weeks or so. I think February 1st is the date that they will release their next rate hike, and I'll talk more about that. And obviously, interest rates will be affected. Of course, at the same time, when you see interest rates being affected, that affects sales, that affects prices, and we have already been seeing, some market shift. In fact, for the last 6 months, 7 months or so, the shift actually is pretty obvious, and I'll talk more about that. Home sales have declined. Prices actually start declining a little bit depending on which area you're in. But if you look at the state as a whole, the statewide median price actually start declining on a year-over-year basis for the first time since maybe 2020. But in some areas, you might actually have already seen some decline in prices. They could be due to mix of sales change, but they also could be due to actual price depreciation. Remember, we did have home prices increase by double digit for maybe 2 years or so from in 2021. Even in 2022, if you look at the year as a whole compared to the year before, we actually are seeing a close to 10% increase, again depending on which area. But things are going to look a little bit softer in the upcoming year in 2023. Here in 2023, we do expect the sales to continue to stay at a low level, at least for the first few months of this year. I think in November, we might have already seen closed sales dip to the lowest level, at least for the state level. And first, I need to apologize also that we have not released our December's number. The release date is actually on the 18th, but already got some numbers, preliminary numbers. I won't be able to release the state number, but I did put some city level and maybe some LA County number in my presentation. So just don't let my media relation person know, because she doesn't know that I'm releasing some of those numbers in my PowerPoint deck. But it looks like, at least for sales, it might have already bottomed out, in November. In December, things actually, those things are still weak, but, it seemed to be a little bit better. And January may be a little bit better also, partly because of what happened with rates. As I mentioned, a couple months ago, we saw 7%, maybe 7.25% for 30-year fixed rate average. And then it actually is turned out to be a little bit better now in the last few weeks or so. It will probably go up slightly, in the next few weeks or so, depending on the situation. But I think we might have seen the bottom in terms of sales. Probably we'll see some improvement. But in the first quarter, we all know, it is still in the first quarter. We typically have, slow, it's a slow season. We probably still have, activities being a little low compared to a year ago. So it will probably, and the other part of it is also supply. Supply has been tight. Many of you already know because of people not putting their house up on the market. I'll explain a little bit more about why that is the case. So let's get started. Let's start with some econ update first. Now, as I mentioned, inflation continues to be, the one of the major factors that actually continue to affect interest rates, continue to affect the market. And this morning we did have some numbers being released this morning, and the CPI number, the consumer price index number, was released. They were released maybe 5 or 6 o'clock this morning at our time. And here are some numbers. If you look at that blue line, and the very last number in the blue line, it says 6.5%. The inflation actually at one point went all the way up to 9%. 9.1 to be exact, and then it has come down. It's come back down slightly in the last few months. In November, I think it was 7.1%, but the month before that was 7.7%. It's now come down to 6.5%. Now, 6.5%, of course, is still a high number. Remember, in the pre-pandemic level, we actually had 2.5% for years. And when we entered 2020 during the pandemic era, we actually had below 2%. But then because of the pandemic, there had been a lot of supply constraint. Some of the factories, shut down. We had some protocols on the pandemic, and there were a lot of things that affect, the supply at every level. And as such, we have been seeing prices climb up, as demand started coming back. And so it went all the way up to 9.1%, but it has been declining to 6.5%, which is great. That's actually what many economists predicted, at 6.5%. Now, the green line right there is the core inflation. The core inflation takes away the more volatile item, such as food and energy. And that also has come down to 5.7%. Now, I dived into, the report this morning. There are some items that, of course, that we are still somewhat concerned, but, typically the economists look at, two things, the goods part, the inflation on goods, manufactured goods, and then inflation on the service sector, and then of course the individual items as well. It looks like service sectors also have come down in terms of its inflation, so that's good. It started coming down. The other thing that also you may have caught it from the report is the shelter cost. Shelter cost actually is a huge component, and it's actually continued to rise, but they typically lag behind that because of how it's being calculated. That figures usually lag behind what happened in reality. You might have heard from Zillow or from someplace else about the cost of rent. They actually started coming down, or slowing down, I should say. And of course, home prices, shelter costs, part of shelter costs also have come down. So we know that those numbers will eventually get reflected on the CPI. And in the upcoming months, in about a month, 2 months or so, that hopefully that inflation number will continue to go down. Now, the more obvious reason for inflation to go down is, if you look at the chart on the right-hand side, it shows you gas prices. Many of you, drive, and you probably have noticed we did had a little bit of an increase in maybe during the holiday season or the last couple of weeks or during December on gas prices. The prices, at the gas pump, it did go up a little bit, but I think recently in the last week or so, people started going back to work, and gas prices actually started slowing down a little bit. In fact, over the weekend, I think it has come down by, 1% or so, or 1 cent or 2 cents or so. In California, it might be a little different, but overall, at a national level, it actually started coming down. It's hard to believe, though, if you compare it on a year-over-year basis, that $3.28 at national gas price actually was lower than a year ago. Remember, if you look at that chart right there, right here, you can see that at one point it was around $5, maybe 5.25 in California. In LA, we probably had $6.5 per gallon at one point. So it's good to see that. I think the gas station that I usually go to, it's at like $4, $4.20, something like that, and it probably will continue to slow down a little bit in the upcoming year. So, of course, inflation, if you look at the consumer price index, and based on those numbers released by officials, it looks like things are actually doing well. But what about consumers? How are consumers, what are some of the expectations that consumers have? Because it does have an impact on what the expectation is. When people expect more, when consumers expect more, sometimes they ask, their employers to raise their salary a little bit more because of inflation. They're willing to pay a little bit more on certain things if they know that there is inflation isn't a factor. But of course, if consumers have a different expectation on inflation, if they believe that things should not be rising that much, then they make some assessment, and it will have some effect on the overall economy. So take a look at this inflation expectation chart. The New York Fed actually released some numbers about a couple days ago, and you can see the blue line right there. That's the median 1 year ahead expectation. That's how what people believe prices will go up in a year from now. And based on their December's number, most people actually believe that a year from now, the prices in general will go up by 5%. Now, that is still a high number, but take a look at how it compares to, previously, and 3-4 months ago, it was somewhere around 6.5%, and it started actually declining. And it has something to do with, of course, the money that people pay on, let's say, gas and food. So they started seeing those prices actually started coming down. Then those numbers, when those numbers go down, their expectations also come down slightly, but it's still about 5%. It's still at 5%. And if you look at the other two lines, the red line and the yellow line, they also kind of continue to stay at above 2%. That suggests to me that, yes, people expectation of inflation has come down, partly because prices have come down, but at the same time, they still expect 3 years and 5 years from now, things are still going to be above, what we have seen in the past, which was at 2.5%. Things are actually still at a higher level. But again, those numbers also have come down. It used to be somewhere around 4%. Now it's come down to 2.5% or so. So things are looking a little bit better as from the consumer's expectation. What about the Federal Reserve? Now, the Federal Reserve have been doing, their jobs on raising rates, obviously, to keep inflation from flaring up too much. And, of course, we believe sometimes they might be doing a little too much. I believe someone asked about, interest rate predictions, and I'm going to get into that very shortly. So if you look at, the Fed funds rate, this is the Fed funds rate and how much, the Federal Reserve have been raising rates. If you look at the column right in the middle right here, you can see going back to March, that's when March 2022, that's when they actually raised rates the very first time by 25 basis point and then a 50 basis point. And from that point on, they actually raised Fed funds rate 4 times by 75 basis point from June on all the way to November. Now, the very last meeting, the December 14th meeting, they actually raised rates by 50 basis point, which was somewhat expected because they started seeing inflation slowing down a little bit. Now, if you look at this rate change, you can see, and if you look at the column on the right hand side, the Fed funds rate target range, you can see how much Fed funds rate actually has improved over time. It started with, as I mentioned, at a range between before March 17, it was actually 0 to 0.25, and then it started rising, by 25 basis point, 50, and so on and so forth. Right now, the target range is between 425 and 450. Now, what is the relationship with this Fed funds rate to 30-year fixed rates? Usually, of course, there is some lag, on when they raise rates, it doesn't necessarily mean that interest rate change, because people usually have those numbers baked in. They try to anticipate what the Federal Reserve will do, and then they act accordingly a few months in advance. But you can add maybe about 200 basis point to the Fed funds rate, and you get a rate that is similar to what we have at for the 30-year fixed rate right now. So if you add 200 basis point here, the 30-year fixed rate is somewhere around 6.25 to 650, which is about right. Now, sometime it could be a 300 basis point margin, depending on what time and whether there are some surprise from the Federal Reserve. The reason why I want to point that out is I also want to show you what some of the expectations. A lot of people want to, try to figure out, what the Fed funds rate target range is going to be, and that will actually help them determine what the interest rates will actually turn out to be. So there are some probability testings that people normally do every week, every day, every week or so, to try to figure out. Now, here are some predictions by CME Group that shows you what the probability of the Federal Reserve or Fed funds rate actually hitting one of those targets. This is for the February meeting. As I mentioned, the February meeting is going to be on February 1st. And so people have been predicting, even going back to December, what that probability is going to be, well, how likely it is going to hit, a certain target range. Now, back in December, early December, as I mentioned, right now, the target range, for since after the December 14, the target range is around 4.25 to 450. So if they actually hit 450 to 475, that means the Federal Reserve will actually raise rate by 25 basis point, and then the next range is if they actually increase by 50 basis point, and then 75 basis point. A lot of people at the very beginning, or in December, early December, they believe that the Federal Reserve will probably hit will probably raise rates again in February by 50 basis point, and that's why it's in this range. Now, even in early January, about a week ago, we still have maybe about 30% believe that it's going to actually be about 50 basis point increase in February, and that will bring it to 475, 500. But most people now believe 70%. In fact, yesterday, that number actually increased to 77%. More than 3/4 of the people believe that the Federal Reserve will raise rates by only 25 basis point, and it will hit the target range of 450 to 475, so that's the probability. Now, what about the next meeting? Of course, once we want to look at not just February meeting, but look past what's going to happen in March as well, to find out whether the Federal Reserve will continue to raise rates or they will just kind of slow down. So it really depends on what happened in February 1st. But if you want to look forward to what happened with the March meeting, a lot of people also believe that, let's say, if we actually hit 70, if they actually raise rates by 25 basis point, and we are at the target range of 450 to 475, About 2/3, there's a 2/3 of the probability that they actually will raise rates by another 25 basis point in the March meeting. So a lot of people still believe, it will be 25 basis point in February, and then in March it will be another 25 basis point. That's the expectation. Now, my personal expectation is I think they still have there's still a possibility that they will raise a Fed funds rate by 50 basis point in February, and probably then another 25 basis point in March. But after today's, CPI report, I can believe that they will only raise rate by 25 basis point in February and another for 25 basis point in March. Now this morning when I look at the stock market, because stock market typically reacts to it. It fluctuates a little bit. I think it went down and it came back up, and then it might have come down again. I think people are torn. They believe that 25 basis point is probably what they're gonna what the Federal Reserve will actually do. And that's why the market has been flat. Maybe it's come back up, and maybe it's actually more people are believing that that's encouraging news, that things are actually they're going to raise it by 25 basis point, maybe even not raise rates, but chances are they probably will. And the Fed chairman this morning, he didn't mention anything, or yesterday he didn't mention anything about, when he made a speech, he didn't mention anything about being aggressive. He didn't actually talk too much about raise rates, which could be a good sign, because usually he wants to be vocal about it, and kind of let people know, being transparent, that they will actually raise rate. But the fact that he did not say anything could mean that there there's a possibility that they may raise rates only by 25 basis points. So we'll see how that goes, in about 2 weeks or so. Now, at the same time, with higher inflation, it's really hitting consumers. Take a look at this chart right here. This chart actually shows you the retail sales part of it. Now, inflation is a big part, that affects interest rates, but at the same time, how the economy is doing also have an impact on the market as well as the economy. If you look at this chart right here, I've shown this chart before. Last time it was probably with maybe July or August number, but we have November's number. We actually will have December number probably in 2-3 weeks or so. But take a look at this economy, this chart. The increase in prices, overall prices, inflation, does have an impact on sales. In November, we actually started seeing some decline in retail sales on a month-to-month basis. Take a look at this last column in November. It actually dipped a little bit. If you take a look at the some of it may have something to do with the fact that inflation started coming down, so prices, the very first line does not take into account inflation. I think I explained this before, but if you actually take into account inflation, the activity also has come down on a month-to-month basis, and that's the last section right here. It actually dropped on a month-to-month basis. In fact, it also dropped on a year-over-year basis. So on a year-over-year basis and a month-to-month basis, we started seeing some decline in retail sales. This is the first month. If you look at the month-to-month, with accounting for inflation, this is actually the first month in going back to June that we started seeing some decline. We have been doing okay for 3 months, and then we started seeing some decline. It's not a surprise though, because the economy, the fact that the Federal Reserve wants to raise rates is to actually cool off the economy, to cool down the economy, so that we won't have as much demand, and that's the reason why we're seeing some some loss in retail sales. But also the fact that we are also seeing people actually pulling forward. Now remember, we still are, like in November we had Black Fridays, but now we have Black Fridays like throughout the year. It's not just one day now or 2 days now. Amazon, for example, they have sales in July, and then again, I think in October. So some of the sales might have pulled forward, and that might actually affect, the year-over-year change and November and the month-to-month change. Now, don't take me wrong, though. I looked at some numbers. I think we still we're probably still going to see some good numbers. We haven't released, we haven't have our December's numbers released, as I mentioned, but I think, based on some early numbers from MasterCard, their spending pulse, it seems like, on a year-over-year basis on 2022 compared to 2021, um, sales actually have improved. Um, Total retail sales, excluding auto, actually increased by 7.6%. Now, this again may not have accounted for inflation. So when you account for inflation, it may show, a flat number or just a slight increase. But you can also take a look at restaurants, service sectors. It's actually has been improving. So compared to a year ago, we actually have not been doing too bad. But of course, it would be if you take into account inflation, things probably would be a little bit milder than what we're seeing here. And the recent report, we also received a report recently, last week actually, and that's the report that actually keep that pull interest rates down a little bit because it eases some of the concerns about inflation. Now, what does that report say? That report is a jobs report. That report actually shows in December that we had added 223,000 jobs. 223,000 job is actually pretty solid, but it is actually below last few months level. It's definitely below what it was in July and early part of the year. So that number is still solid, and it actually pulled the unemployment rate down to 3.5%. Now, normally when you have a strong jobs report, you're concerned that actually a lot of economists or a lot of people in the market, in the financial market, would be concerned, because when you have a strong report, that could mean that the economy is still humming along very, very well, and that actually could push up inflation. But the report, this actually is a good report because it shows that has a solid number of jobs. It actually declined from a month ago. But the other thing that is encouraging is that wage growth. Wage growth is a number that people look at. Wage growth actually has somewhat moderate. It has come down to 4.6%. The month before that, I believe it was 4.9%. So it started actually coming 4.8%, I think, the month before in November. So it's actually started slowing down. Now, wage growth is one of the components that determines inflation. So when that actually starts slowing down, that is encouraging. So this is what economists would call like a Goldilocks report, that you have on one hand the strong the job report still shows that it's pretty solid, but it's not really solid to a point that it's pushing up wages significantly. So this is a sign, as many market participants took it as, maybe the Federal Reserve can actually achieve soft landing, which is the ideal situation. Now, I personally think that we probably will still get into mild recessions, as I mentioned, but this is an encouraging report. And because of that reason, people start easing their concerns about inflation last week, and that's why you saw that interest rate, a 30-year fixed rate, actually dropped from somewhere around 6.4 to 6.2% or something like that. So let's take a look at the housing market. Now, enough about economy for now. We'll talk more about that later on. But, of course, with all the background information that I just gave you, you know already without even knowing the market, the economy, that our market has been slowing. The market has been slowing, of course, partly because of high interest rates. High interest rate leads to mortgage payment, but the sentiment. Here are some sentiment, from buyers and a seller later on, that shows you why we're seeing some slowdown and some slowing in the housing market. Now, buyer sentiments actually, this is a survey collected by Fannie Mae, and it asks about home purchase sentiment, and it asks whether people ask consumers whether it's a good time to buy or a bad time to buy. And if you take a look at this blue dotted line, the latest number shows that the number of people who said it's a good time to buy actually start increasing from 16% to 21%. Now that's actually an improvement. That's great. Now compared to where we were at, let's say a year or 2 years ago, of course, it's still a very low number, 21% as compared to 2 years ago, it was 52%, and a year ago it was 26%. But it's actually improving slightly. And part of the reason that could improve that things have been improving, maybe because of the mortgage outlook. I think they pointed out, the Fannie Mae pointed out three things. Mortgage outlook is one reason why we're seeing some improvement in sentiment. The other one is, whether people think they will lose their jobs, and think the jobs report that I showed you earlier is encouraging. That might have supported by some buyer sentiment, but still, of course, that number is still low at 21%. Number of people believe it's not a good time to buy is still at 76%. So it has improved, but it's still not good. What about sellers? Sellers might be a little different. They're actually a little bit more positive, but still, compared to a year ago, it is not as positive. If you take a look at this blue dotted line again, 51% still believe it's a good time to sell, but it is below what it was before at 76%. And that's because of high interest rates. But it is also has been sort of leveling off a little bit since it started dropping in the last, I think, few months. Started leveling off at around 50%, 51% or so. Now, part of the reason why it might be tough for people to sell is because of the lock-in effect that I will talk about a little bit more. Take a look at interest rates, and that explains, a little bit of why buyers and sellers may actually feel a little concerned. If you look at the interest rates, the blue line is the daily mortgage news daily's number, and the orange line is the Freddie Mac's number. Freddie Mac's number, I apologize, I don't have the latest that's being released, that was released earlier today. It's probably show a slight decline, similar to the blue line, but the blue line actually dipped slightly. But still, at that, even though it dipped, it continued to be above 6%, and that's one of the reasons why we have not been seeing sales as robust as a year ago or 2 years ago, or 18 months ago. Take a look at what happened with interest rates rising at that rate, and I show you previously, mortgage payment has been growing. Mortgage payment has been growing by 30, 40, 50%. In fact, the latest number in November shows us that it's actually increased by 53%. So with the 53% increase, that's actually even worse than what I showed a few months ago when we had our meeting in August. I think it was up like 40% or so. Now it's 53%. Now, I believe things probably will improve slightly in the upcoming months, with prices actually slowing down a little bit, and interest rate hopefully stay at around 6% and maybe even below 6%. But it's most likely going to continue to stay at a level that actually might affect sales. With mortgage payment at such a high level, a lot of first-time buyers may not necessarily be able to come up with that payment. Either they'll have to come up with a bigger down payment, or they will have to come up with a higher income to qualify for the monthly mortgage payment. And that's getting a little tough for first-time buyers. Now, first-time buyers make up about a third of all sales. So, it affects first-time buyers, and that could actually take out 6 or 7% off those sales. At the same time, the repeat buyers, they may not be as impacted by the increase in mortgage payment as the first-time buyers, but of course they also are concerned about the lock-in. They're affected by the lock-in effect, because they don't necessarily want to switch, buy a new home, or trade up or trade down to a new home with a much higher interest rates. And that's one of the reasons why you're actually seeing repeat buyers pulling back as well. And that's why it affected sales. Sales actually, I think last time in August when we talked about sales, it was still okay. And then the last few months, we actually started seeing some decline. Take a look at, the change, year-over-year change in the the chart right here on the right hand side, you can see that in the last few months it actually has been dipping. Sales have been dipping quite a bit. In fact, in November it actually dipped by about 47-48%, pretty significant. We do believe though, with the December numbers, like I said, I don't have the December numbers, that I can't release those numbers yet because I'm still working on it. But I can tell you what the year-over-year percent change kind of look like. It actually looks a little bit better than this. And that's why I believe we might have seen the bottom. It's better than the 47%. I mean, it's still at, somewhere close to 40% or so, but it's actually better. And, based on the pending sales number, the open escrow sales numbers that I've seen so far, I think, January will be a little bit better. Now, it will take some time for us to get back to the level that we were at before. And I think it might be a little tough, to see, we may not even get there, in the first half of 2023, but we're slowly improving. And it actually affects, if you look at this sales by individual price tier, you can see this is why I said, things have gotten worse compared to before. Now, back in mid of 2022, we actually saw on a year-over-year basis decline by 48% for the lowest price range, but for the other price range, maybe around 20% or so. But take a look at in November, things actually have gotten worse for the higher price range as well. Now, the higher price range dipping does have an impact on prices. When you're selling, when sellers are, when there are fewer homes being sold at a high price range, it affects the mix of change, as I mentioned before, and it affects the median price. Now, take a look at the median price. Median price actually, it continued to stay at a pretty decent level for from say July through October or so, but lately we started seeing some decline on a year-over-year basis. If you look at this blue line right here, it actually experienced its first year-over-year decline in the last 30 months for the state of California. Some areas might actually be dipping a little bit faster. And the higher price range actually could be seeing some volatility as well. Now, if you look at individual price range, you're seeing a little bit better movement, and that's why I said mix of sales actually could be a factor as well. If you look at individual price tier, this is the lowest 20th percent of sales, which probably is around from zero. This is a price range between maybe 0 to 400 to 450 or so. And the highest price range of 80th to 100 percentile, that is probably some price range between maybe 1.25 and above. And if you look at just individual price range, it looks like they're still growing a little bit. So that's why I said mix of sales could be one of the factors. And if you have fewer higher price range, higher price homes being sold, it affects the median price. But I can tell you that in the upcoming months, we probably will start seeing some slowdown, more slowdown in prices. We expect, I'm jumping forward a little bit and you'll see those numbers at the very end. We believe that prices will drop about 7 or 8% this year compared to last year for the year of 2023 compared to 2022. So it will go down. And on a month-to-month basis, we're already seeing the peak price that we saw. Maybe it was about May or April of last year. And from that point on, we actually started seeing some month-to-month decline. From the peak to the current price, we might have already dropped by about 8 or 9 or 10% or so. But of course, there are some seasonality involved as well. Typically, we do have between, let's say, May or June to the beginning of the next year, we typically see a drop off about 5% anyway. So we have been seeing some drop off. And the reason why we actually have not seen a much bigger drop off is probably because of supply. Now look at the supply right here. Now if you look at the active listings, this is active listing at the state level. If you just look at active listings overall, you might think, wow, this is actually a significant increase. We're seeing an 80% right here. We're seeing an 80% increase in active listings in the month of November. Now, the year-over-year change, yes, that is a significant number, but that actually is partly due to a pullback in demand. Remember, we actually saw a 40% of decline in sales. So that actually plays a role. If you look at actual new listings being added to the market, they actually have been very, very low. If you look at again, these are November's number. You can see, from this chart on the right hand side that it's actually has been declining by double digit. In fact, in November it actually dropped by 16 or 17% for listings being added to the market. So new listings are actually very, very tight. And the reason why it has been tight is because of the lock-in effect that I mentioned earlier. People lock in at 2 to 3 or 4%, and they're not willing to put their house up on the market and trade up for a higher mortgage rates. Now, these numbers were collected from Freddie Mac, as of June. Take a look at the chart on this right-hand side. Based on their portfolio, Freddie Mac's portfolio shows 63% of their mortgages that they have on hand were below 3 to 3.99%. The other 20% of the mortgages were actually between 2% to 3%, and 16% of those were between 4 to 4.99%. So about when you add all those up, that's over 90%. A significant number of mortgages were actually below the 5% interest rates. So that's the reason why there's a lock-in effect. People currently, the mortgage rate is at 6.25, 6.5, depending on who you talk to. And that's why they're not releasing, or they're not putting their house up on the market unless they have to. Because if they actually trade up, they actually have to pay a higher rate. They have to pay a higher mortgage payment, and that's why you're seeing a very short supply in the last couple months, last 6 months or so. Now let's take a look at some regional numbers. I was able to pull together some numbers for the year as a whole for individual county. Let's look at county first, and then I have some individual city level data that we may not be able to go through everything, but at least I have those available that you can take a look at. Now, on a year-over-year basis, I compiled the individual year going back to 2016. But take a look at what happened in 2022. If you look at LA, if you look at Ventura, you can see there's a dramatic drop, between LA between 2021 and 2022. In fact, that drop is about 25.2%. With Ventura, it also it's not as obvious, but it also dropped about 26-27% compared to a year ago. So 2022 was not, in terms of sales, it was not great. We actually dipped quite a bit. Now it affects, all the other counties in Southern California also dropped. Some actually drop even bigger. 31% for Orange County. That's pretty significant. And San Bernardino also dropped about 30% or so. So every single county in Southern California pretty much dropped, by, over 25% or so for the year 2022. In 2020, and I think, and again, we will have those finalized numbers released in a few days, I think on the 18th. At the state level, I think for 2022, we actually might have dropped by about 23% or so. A little bit bigger than our original predictions. In October, we projected the number will be about 19 to 20%, but it actually dropped even more because of what happened in the last 4 months or so, in the last 4 months. So, but price-wise actually has been doing a little bit better. If you look at median price by county for individual county in Southern California, here are the numbers. LA County actually increased from previous year by 19%. take a look at Orange County, take a look at Riverside, and take a look at San Bernardino and Ventura. That actually happened pretty significant. That actually, I'm looking at that number again. Actually, I might have that number should be a little bit lower than that. I think it's more like 6 or 7%. I'll correct that and then resend the slide. I'm just doing it. Oh, I might have actually used a number that was a calculation between 2021 and 2020. But the other calculations should be correct, should be right. And I apologize. I'll go back and make that change later on. But if the story is that we are still seeing 2022 to 2021, the number actually is still a positive number. Now, towards the end of the year, the number actually have slowed down, obviously. And it has come down to, for in every county, I think we might have seen a smaller decline. Is a small decline, maybe even well, a 1.2% increase, or maybe even a smaller decline, and that price decline probably will continue in the upcoming year. As I mentioned, at the state level, we expect a 7 or 8% decline at the state level. For individual county, for LA County, for example, LA County makes up about 50% of, or maybe about 35% of all sales in California. So, it's safe to say that we probably will see a decline in sales, a decline in price in LA that reflects, what's happening with the state as a whole. So expect LA to drop maybe about 6 or 7%. Now, it's not going to drop as significant as what we saw back in the Great Recessions because of supply constraint. Now, again, I'm showing you, the inventory level. The inventory, it seems like, things are actually improving, and it looks like, it's 60 to 70% higher than a year ago. But if you look at the new listing, as I mentioned, new active listings added to the county or to the MLS, it seems like they actually have been decreasing. On a year-over-year basis, for LA, for example, it actually decreased by 28%, and for Ventura by 33%, and it fluctuates, but in between, Orange County 24%, and San Bernardino about 14% or so. So it's getting a little tough. And I'm reading, one of the comment, of course, about new home sales. New home constructions also have not been. We have not been seeing a lot of new home construction as well. Now, there have been some development. I don't have a slide here. I typically have a slide that shows you new housing permits. But new housing constructions have been below the demand. We have been being below that number of demand, and the reason, and the number will probably drop also in 2023, partly because a lot of builders, a lot of developers actually have been switching gear. They have not been actually building the single family homes. They actually switch over to multifamily because the rental market actually is going to be the focal point in the upcoming year, because the rental market is booming, partly because of high interest rates. People may not be able to buy, and so a lot of developers, builders actually have switched over to a different to the different market, and they may not actually come back until maybe 2024. So we will continue to see some tight supply in both the existing home market as well as the new market as well. Now, and of course, that in one way is actually keeping prices from dropping too much. As I mentioned, part of the reason why we're not seeing what happened in 2008, 2009 is because we don't have as much inventory as what we had this year compared to what we had in the past. We actually are seeing prices actually dropping, but not dropping as much, and that actually keep housing affordability. That will keep housing affordability at a low level. This is the third quarter number, and we will come up with our fourth quarter number in about a month or so. But the third quarter numbers suggest that we still have a very low housing affordability level. For LA, for example, it is at 13%, lower than the state at 18%. This number shows you the percent of households that can afford to buy a median price home. In an ideal world, a median price home is, if we have an ideal world, then 50% of the people of the households could afford to buy a median price home. But obviously, in California, that's really tough to achieve. I don't remember. We might have achieved 50% a long, long time ago when we actually had the housing crisis in 2009, 2010, but then it has come down significantly, especially with interest rate at 6.5%. So let's take a look at some local housing market updates. Now, I'm not going to go over every single slide, but I'll show you the slide. I should say I will not be able to discuss every single slide, but I'll show you the slide. I have different areas, Calabasas, South Bay, West Side, and Long Beach. It shows you a similar trend. Now, some areas, because of the number of observations, it may see some fluctuations that is different from the state as a whole or for the region as a whole. And that's because of lower number of observations, lower number of transactions. But, the story is pretty similar. You see that, on a year-over-year basis, most cities drop on by 20-25%. Some of them maybe even higher. Take a look at Gray Hills, Calabasas, Westlake Village, and here are some, median price by city. Some city continue to show, an improvement in terms of price. Now, this might also have something to do with like I said, lack of number of transactions and the mix of sales change. We may be seeing some change in the mix of sales when the mix of sales change will be more obvious when we actually have fewer transactions. And then here now the number here is the yearly median price, and then here are the median prices by city for December only. This shows you by looking at the year-over-year percent change at the monthly level or December. It shows you the more short-term fluctuation. On a year-over-year basis for the annual number, it shows you just the overall picture of what happened in 2022 and 2021. Quickly going to go over them. Now, the last slide for this set of data is active listings. Again, it shows you inventory actually shows that it's improving, but this is not new listings. I actually don't have new listings for individual cities. We probably will have some. If you're interested, let me know. Long Beach, putting Lakewood and Long Beach in there, similar story. Sales dropped pretty significantly. Price actually improved for the year as a whole for Lakewood and Long Beach. But for December, we are seeing some decline lately. We started seeing some slowdown in both cities compared to a year ago. Active listings, again, inventory shows that it's improving. Then again, that's because of pullback in sales. South Bay, I have a list of cities in South Bay, quite a bit. I'll let you read through them. But again, sales actually dropped for almost all of the cities. Actually, all of the cities by maybe about 25% or so. Some actually a little bit higher. But for price, for the year 2020, I apologize, this should be 2021. It shows that it's actually improved on a 15-16% basis. And for individual city, December actually shows, if you look at the very last column on a year-over-year basis, that actually dropped for most cities, except maybe for Rancho Palos Verdes, it inched up a little bit, and Torrance. And for their active listings actually show similar story, increase because of inventory, because of pullback in sales. And I think the last one is West Side. West Side, as far as cities are concerned, Beverly Hills, Culver City, and Santa Monica all dropped quite significantly in terms of sales by 25%, 27% or more. And if you look at price, they all increased a little bit by about 10%-ish or so for the year as a whole. And for the month of December, Beverly Hills actually dropped. Now this number is a little too big. I believe again it is probably because of the mix of sales. We have very few transactions for Beverly Hills. Culver City and Santa Monica, we probably have a number of transactions that is maybe 10 or so. So, when you look at a number of transactions that might be a little that may not be a big number, it sometime the mix of sales could actually take over the calculation and give you a misleading picture. A better figure to look at is probably look at the price per square foot, and of course we can do comms, but the price per square foot is probably a better number to look at. And then the last one is the active listings. Again, it shows significant increase in active listings due to pullback in sales. Now let's take a look at what we can expect in the upcoming year. Now I already gave you some background information about the inflation situation, but of course we want to know where it is heading. What about what do we think the Federal Reserves are going to do? What is going to happen to Fed funds rate? Now, if you look at the chart on the left-hand side, the CPI and the core CPI number, these are numbers that actually got updated by UCLA just recently. They released their report I'd say recently, mid of December. If you look at the PowerPoint that I sent to you before and look at this PowerPoint, you can see that the CPI number actually improved. UCLA actually improved their, revised their numbers and actually improved their predictions for inflation. Look at the inflation number. They used to have for the CPI, that's the headline number that includes energy and energy and food. The fourth quarter, these are a quarterly number. So this number, 2.8%, that's the fourth quarter number of 2023. It used to be about 3% or 3.5% or something like that. They improved it. They changed it to they lowered the number a little bit because of the numbers that we have been seeing. And they believe that, inflation actually has calmed down a little bit. And they believe by 2024, we actually will see a below 2%. And the core inflation, also, core inflation takes away the energy and food. They also suggest that things are actually going to go down to below 2%, which is a little bit more positive compared to the report before. And the Federal Reserve actually are showing their commitment in the dot plot that suggests that they probably will slow the pace growth of rate hikes in 2023 as well, but they still expect the rate hike there will be rate hikes in 2023. Take a look at this dot plot. The dot plot is these dots are votes from individual Federal Reserve officials. When they actually submit their votes, people tend to look at those dots and try to figure out, what the midpoint is. The midpoint is used to determine what the Federal Reserve actions probably is going to be. And you can see by the end of 2023, they still believe, all the Federal Reserve officials, when they submitted their votes, they still believe that they will have a higher rates than in 2022. In fact, by maybe about 50 basis point. So think about it. If they actually raise rate by 25 basis point in February, and then another 25 basis point in March, and they leave it unchanged, then it will be 50 basis point. And then in 2024 and 25, that's when they actually will lower rates a little bit. They'll lower rates a little bit all the way to maybe 2025. So rates probably, if the market looks forward to the Fed funds rate and they predict that they will actually start lowering rate in 2024, then mortgage rate will start coming back down. And I believe mortgage rates probably will be down maybe in the fourth quarter of 2024. Now, and the reason why that is the case is if you take a look at the supply chain, if you look at inflation, it has a lot of time it has to do with how tight the supply is, right? Just like the housing market. So the supply chain here will give you an idea of whether things are actually tightening up or not. If you look at this line right here, I've shown this before. every time this blue line is above the zero line, that suggests to us that we are above the average normal level. So it is tighter. Supply is still tighter than before, but you can see that it has come down quite a bit. And we're actually closing in on the zero line. So that means supply chain is improving. And that's, suggests that in the upcoming year, things are actually going to look a little bit better. Now, of course, the inflation is only one thing that we have been looking at. The other part of it is whether the economy is going to go into recession. So here's what we want to look at. We want to look at households. We want to look at whether households actually will be financially well off or not compared to a year ago. Now, if they are going to be worse off in the upcoming year, then that actually will lead to people spending less money, and that actually will lead to the economy shrinking a little bit. Now, if you look at this yellow bar and the blue bar, when you add those numbers up, if those numbers are actually at a high level, that means things are going to get worse. And we saw a number that is actually at a pretty high level in mid 2022. When you add the yellow and the blue together, it was about 40%, meaning 43 or 44% of the people believe that things are actually going to get worse. But that number actually started declining. So people or consumers are feeling more optimistic in the last few months or so. Maybe because of interest rates, maybe because things have improved in terms of the inflation. It could be a lot of different things. But they are a little bit more optimistic as far as their finance are concerned. Now, that doesn't necessarily mean that they're not going to spend less. Take a look at the household spending growth expectation. Even though they think they are going to be financially okay, they probably will start spending less. And part of the reason is, when you have interest rates at a high level, when you use your credit card to borrow money or use your credit card to pay for things, if interest rate is at a high level, then you probably don't want to use it as much. And that's why people have been cutting back on spending. Also, the saving, people have not been saving as much. The savings might have already been depleted because of what happened in the last few months or so, in the last year or so. So people plan on spending less in the upcoming year. And business leaders, they take notes. I've seen, I might have shown something similar before. When business leaders notice that things are actually going to soften up a little bit, obviously they're going to cut back. Take a look at the CEO confidence for the US for 2020, the last quarter of 2022. Their confidence actually has gone down to a low level, lower than what we saw in 2020, in fact. And if you look at the chart on the right hand side, 85% believe that we will actually have a brief or shallow recession in 2020 in the next 12 to 18 months or so. So when they have that belief, they usually what happens is they usually cut back. Now we're going into recessions, but when are we actually going to come out? Here's another chart by Conference Board again that shows you what the business leaders believe we'll actually see some positive number in their region. Now it's a global survey, but if you take a look at the US, you'll see a lot of people believe that we'll have to wait until mid 2024 before we actually see some positive economic growth. So they will plan accordingly, and we will probably end up seeing mild recessions, as I mentioned, because of how the consumers react and how business leaders react. So here's our forecast for the economy. We believe in 2023, we are going to see a mild recessions. And if you look at the US GDP number, you see a negative number, that suggests a recession. Last time when I was here in August, it still showed a 1% increase, but we changed our forecast since then. We actually believe that it will be down by 0.5%. Now, if it turns out to be a positive number, that's great. I'm happy that my projection is wrong, if that's the case. But if right now, it looks like that we are going to see a mild recession, most likely in the second or the third quarter of this year. Looking more like the third quarter now. Now, if you look at unemployment rate actually dipped to 3.7% for the year as a whole, but it's also going to actually start increasing. Now, 4.4% is actually not too bad. If you look at how it compares to the previous year, that actually is a pretty decent number. And the number could be actually even lower than that. And what about CPI, the inflation number? Inflation number in 2023, we believe it's going to slow down from 8% in 2022 to 4.4%. Now, it could be a slightly higher than this, but I still think 4.4% is achievable. And for California, for the state, we are still seeing a job growth in 1% for the state as a whole, and unemployment will actually inch up to 4.7%. Now, let's take a look at the market briefly. I have maybe about a few more minutes, and I'll be we can do some Q&A if we have time. Now, what about the market? If you look at the market, of course, you have to look at a few things. You have to look at what consumers plan on doing. Now, consumers, from the same survey that Fannie Mae released about housing home purchase sentiments survey, it suggests to us that they believe home prices actually will go down. In fact, on average, people believe that home prices will go down by about 1%, 2% or so. Now, what happened when you have consumers, you have buyers who believe home prices will go down? Some of them will wait, especially when some of them actually believe that rates actually will go down. If you look at rates from this same survey, the consumers or respondents who said mortgage rate will go down in the next 12 months, that's the blue dots, that's about 14%. Now, more people, it used to be 6%, now has come back down to 14%. So 14% actually believe that interest rate will go down. Now, some actually believe that it will go up quite a bit, 51%, but 14% believe that it's going to go down. For some people believe that it's going to go down, they may actually hold off on buying until rates start going down and prices going down. So that's the reason why we're seeing some slower sales right now. Now, if you look at those mortgage applications, which will turn into closed sales, mortgage applications, which is represented by that blue bars, they actually have been below last few years level, below 2018, below 2019 and 2020 and 2021. So we are having a tough time right now, with sales activity, partly because of buyers not jumping into the market because of affordability, also because of sellers. Now, that's why properties are staying on the market for a little longer, 24 days in November compared to 11 days the year ago. So properties are staying on the market a little longer, and fewer buyers are actually paying above asking price. Now, with fewer buyers paying above asking price, that obviously has an impact on prices. Home prices actually have been adjusted downward. Listing prices actually have been adjusted downwards. I'll show you another slide later. That actually has come down. In fact, about I think 30 or 30% or 40% of the sellers actually have adjusted price downward, and that actually could have an impact on prices overall. We probably will see some slowdown in price. As I mentioned at the very beginning, we're going to see maybe 7 or 8% percent decline in price. But at the same time, we have some optimism, we have some positive thoughts here, because mortgage rates actually started coming back down to the 4-month low. Now, I won't say that it will break 6% in the next few weeks, but it may not actually hike up to 7% again this year. I'm speculating. Obviously, things could change depending on inflation, but it looks like inflation is trending down, and we're actually looking at inflation actually going to continue to improve in the upcoming months, especially since what I mentioned earlier, shelter costs, they lagged behind what actually happened in the market. So that actually could lead to more inflationary downward pressure in the upcoming months, and that could affect the Federal Reserve decisions to raise rates. Now, this is what I meant. This is a slide that I meant earlier, reduce price listings. we have more people reducing their price close to 45%, and that could affect price level. And I do believe that, we are going to see some moderate price decline, partly because of what happened with mix of sales change. And, we are not seeing, the things falling off the roof, partly because of we're not seeing too many foreclosures. We have some foreclosures, but very, very minimal. And that's the reason why we're not seeing those foreclosures, because we're different compared to 10, 15 years ago. A lot of people actually pay a heftier down payment compared to before. Fewer people actually put zero down payment. And people have locked in with a low rates, and many of those are not going to go default. Now, here's our forecast. Here's our outlook for the housing market. We believe, as far as sales are concerned, we are going to see a drop of sales by maybe 7%, maybe actually even a little higher. We probably will adjust those sales numbers maybe in the end of first quarter. But if you look at price will be down probably by about 8%, 9% this year. Part of it could be due to mix of sales change. Actual change in price could be about 4 or 5%. And 30-year fixed rate, if you look at the 30-year fixed rate on average, now this could be actually a little high, but I'm going to be a little bit more conservative for now. It's going to be at around 6.6%, but it could be a little bit lower than that. And let's see, with that said, what I get a lot of, questions about, people ask, during this particular market, what do we need to, what can we tell, buyers and sellers? Well, first, you got to believe in, our profession. They need trusted advisors right now. Buyers and sellers both need, people to help them to understand the market a little bit more. They need advice. They need to know, what market to move to. They need to know more about interest rates. They need to know about, the financing options. So they need a lot of help from us. And, for people who ask, is it a good time to buy? Is it a good time to sell? Some of your sellers may not, some of the buyers and sellers may not want to get into the market now. These are some of the answers that I will give them. Of course, not everyone can get into the market right now. There are some buyers, there are some sellers who could actually get in the market right now. And these are some of the things that you can tell them. For first-time buyers, of course, prices actually could go down further, but mortgage rates will go down also. But we can always refinance if you actually can find a home that you really like and lock in a rate and find lock in a price. Then you can always refinance later. Repeat buyers, we can always tell them, this is a good time. We have some equity gain in the past couple of years. This might still be a good time to sell and then move on to your next properties. And there are all the other different answers for what you might actually want to tell your buyers or sellers. So take a look at this and see what you can, whether you can use any. Now, to wrap it up, the market is going to be tough. It's going to be challenging. Home sales will remain weak, because the economy will continue to be uncertain, and we'll continue to have housing affordability issue. And supply will also be tight because of those lock-in effect that I mentioned earlier. In 2023, we will have some slowdown in prices, but supply shortage will actually keep prices from falling too far. Inflation, though, is improving. I think we can look forward to the second half of the year with some mortgage rates actually started coming down again in the second half. Now, Fed funds rate may not come down, but mortgage rate actually might slow down a little bit towards the second half of the year, maybe in the third or the fourth quarter. Now, that is when I think things could actually improve a little bit and, sales activity start picking up again. It is still going to be a tough year, and buyers and sellers, they need us even more to navigate through this market uncertainty right now than before. With that said, that should wrap up the presentation. I'll make some changes to those slides that I missed and resent to Kim and Manny. I will turn it back to Manny with any Q&A. Let me stop share for now.
Thank you, Oscar. That was incredible overview as always, and I love the slide at the very end that you recommend, things you can talk to the sellers, buyers, investors about. Let's go over the chat for a second. See, the questions over there, you probably covered a few, but if you don't mind, just kind of take a look and see. Rosie said, how much do you predict the interest rates to decrease and by which quarter? So take it from there. I think you answered most of it, just to make sure.
Sorry, I'm muted. Okay, so yes, let me take a quick look. Yes, regarding interest rates, I think I briefly talked about it. I left it probably towards the end. Interest rates right now, it is at, like I said, 6.2, 6.3%. Now, I mentioned earlier that yes, it's going to continue to fluctuate. You may actually see rates go back up, to 6.5, 6.75 or so. But towards the end of the year, I believe, when inflation starts settling down a little bit, when you started seeing, the Federal Reserve stop moving the Fed funds rate, you will start seeing some rates coming back down, especially when recessions, when we expect the recessions, because they need to stimulate the economy. Now, they may not necessarily cut Fed funds rate until 2024, but I would say, I think, mortgage rate will start coming down. Now, right now, and as I mentioned, let's use right now as a benchmark. If it is 6.2, 6.3 right now, and I have in my projections the year at 6.6. So if you look at it from that standpoint, then interest rate actually will go up. But if you look at it from the peak, at some point, it may actually hit 6.75 and then start coming back down. I think at the end of the year, let's use a year-end number. At the end of the year, I wouldn't be surprised if we actually see a 6%, but I wouldn't go more than 6%. It is possible that we may actually see 5.8, 5.85, or maybe even 5.5 if we're lucky. But if we actually see 5.5, that means, the economy is actually not doing that great. So I will say, by the end of the year, you may actually see about, 6% or slightly below 6%. So don't bet on rates going down too fast. Next year, we'll see rates started going down a little bit further, but not this year.
Got it. And Brad, yes, we're going to send the recordings and also the copy of all the slides to everybody. Thanks for asking. Another question about affordability. You did cover that. You want to just give us the highlights about that topic?
Sure. It's about house. Okay, so housing affordability, the home buying affordability will improve anytime soon. So now the buying affordability, those numbers that I showed you earlier, it really depends on two things, of course, a few things. One is, of course, interest rates. The other one is price. And of course, the third thing is household income. Now, household income, let's talk about income first. Income will improve probably by 4 or 5%, this year compared to last year. And at the same time, if you look at it from that standpoint, if it improved overall, income improved by 4 or 5%, and let's say interest rates comes down by from 6.2 right now, 6.2, 6.3. Let's say it comes down to 6% or so. So it comes down a little bit. And then prices will come down maybe about 8 or 9% this year, as I mentioned. So by the end of the year, or maybe even third quarter, we'll probably see affordability start coming back up. Now for LA, right now LA is 13% in the third quarter. Fourth quarter, it actually we will be releasing a fourth quarter number that actually will inch up a little bit because interest rate went down in the fourth quarter. For this year, I think LA, it will probably stay at around 15% for the first quarter. Maybe it will start climbing up a little bit in towards the late second quarter or third quarter or so. By the end of the year, LA may actually still be below 20%, but it might actually be closer to 18 or 19%. So it will probably improve because of increase in income, because of prices coming down and interest rate coming down. Now, if prices do not come down as much, then obviously affordability will not come up as much. And of course, interest rate will have to actually come down slightly. I don't think, again, interest rate will come down that much, but with the combination of all these items, I think we'll see some improvement. It will still be under 20% though. It will take some time for it to get back to a more affordable level.
Thank you, Oscar. There was a question about if the '08 housing crisis will go over again. He kind of, mentioned that, we're not looking into any kind of distressed properties, really. It's not the case. And then does the 2024 election will have an effect on rates? Like usually there's mix of politics influence on rates.
Yeah, so it's a little too early to see to say what is going to happen in 2024, because the focus for 2024 will probably be on what will happen in the economy. Now, if we actually have a recession, then in 2023 and 2024, people will start talking about what they will do to improve the economy.
Right.
If we don't have a recession, and if we actually start picking up at late 2023, then things will be a little different. But rest assured, we'll probably revisit that interest rate issues and Federal Reserve, whether they should be tightening up, whether they have tightened up too much or not. So I don't think so. 2024, so you look at those numbers that I gave earlier. This year sales probably will go down and price will go down. Sales will go down by, I think I have 8 or 9%, and then price also by 8 or 9%. So going into 2024, things will improve. Interest rate will actually be lower, but I won't be able to guarantee whether 2024 will see an increase in price. I think we'll see an improvement in sales, but we may not see an improvement in price. So in 2024, I think people will still be talking about the economy, even though economy probably will still will be okay. I don't think we'll tank. So people will still focus on the economy, and hopefully by then we won't have any COVID. I mean, right now we're pretty much done with COVID, but of course we still have some up and downs with spikes in cases from time to time. And then at that time, in 2024, things actually will improve in terms of traveling, in terms of people going overseas and things like that. So the topic will be a little different, of course, in 2024. I think people will try to lower rates. Even now, right now, people will try to has been trying to lower interest rates, and it's a topic that people want to talk about because they know that interest rate probably will go down in 2024 or 2025 without doing anything. So people will talk about rates, but to be honest, the discussions during 2024, as far as presidential election, probably will not have a much significant impact in 2025 or 2026, because things will already be happening. But we'll see how it goes. But we'll have to see how things actually pan out this year first. Hopefully we can avoid a recession. Maybe we can have a soft landing and things will start picking up again.
Okay, I think we covered some of it, if not all of it. Oscar Way, Chief Economist for the C.A.R. Association. Thank you so much, Oscar, as always. Much appreciated. And hopefully we'll see you in about 5-6 months from now. Get a recap midterm, mid-year, and see how things are going.
Absolutely. Thank you for inviting me. Again, my email address at the end, oscarw@car.org. If you have any questions that I did not have a chance to answer, feel free to send me an email. And Manny and Kim, I'll send you the revised or updated slide deck so that you can circulate it to your audience.
Great. Oscar Way, pleasure as always. Thank you so much. Happy New Year.
Thank you. Happy New Year.
Thanks, everybody.
Thank you.